Good afternoon. Welcome to the TheoTrade afternoon video. I'm Blake Young. Today is February 20th, 2025, and we're going to talk about industrials and manufacturing today. And we're going to start with the Philly Fed Manufacturing Index. The Philly Fed Manufacturing Index is a survey to Philadelphia area manufacturers, which is a big manufacturing area of the country. And if you don't believe that, go watch the elections. You'll see a lot of focus on manufacturing jobs during election cycles, but this is where we get a lot of data from. There's also a Empire State or New York area manufacturing index we'll talk about here momentarily. But today's report on this survey showed it was a major miss. It doesn't mean that it's negative, but it's a major miss. We're seeing a less stellar outcome or output in the manufacturing areas. So we can see this 18.1 is in red. Well, that's because it missed expectations. It's simply better or worse than the forecasted number. Well, it's not just worse than the forecasted number. It's about half of what the previous month's manufacturing data was. Anytime we go below that zero line in the Philly Fed manufacturing, that is market contraction or manufacturing contraction. You can see we've been in that contraction state most of the time since June of 2022. And we saw the decline through here after it peaked. We saw a drop and it got worse and worse and worse until we went negative. The question is this peak and this drop half as what the previous month was, is that an indication that we're going to go negative as well and maybe have another 2 or 3 year sustained negative or contracting manufacturing index? So there's a lot of concern with this in the data as far as for industrial production. If we're looking at this, it doesn't mean that we can't have it go lower and then back up. If we look at the fact that it was January and look back to previous Januaries, is January a big month? Not necessarily. We look at this big spike in January here, definitely higher than the previous month. But as we look into this and say, well, what does February tell us? Our February is usually lower than January's. Going back to the previous January, nope, that one was not the case. Go over here. Does February lower? A little bit, but pretty much flat. We go to 2022. Is there any cyclicality in this? Maybe a tiny bit there. But it really doesn't have a consistent pattern to say that this is seasonality of industrial production. So this is a miss. This does show us that we're missing expectations a lot worse than the previous month. If we look at New York, or what's called the Empire State Manufacturing reported earlier this week, the Empire State Manufacturing data was negative, expected to be negative, and it came in slightly positive. Is this the turn of the corner the opposite direction? That's the question. Or is it simply another one-off that crossed positive and it's going to go right back negative? We've been negative in the Empire State Manufacturing Index all the way back to January of 2022 as well, most of the time. A couple of months went positive, but overall very negative for manufacturing. So we're not really seeing a significant turn and focus on industrials. Industrials could be an indication that we're not seeing the growth and expectations that we would want to in this area, assuming that we need industrials to be one of the earlier turns in a growth economy. If we look at XLI, the industrials ETF, you can see that certainly we see contraction and pullbacks in 2007, 2008. What I like about industrials, it can help us see ahead of time. If we zoom in on that 2007, 2008, did we see a slowdown in manufacturing production demand early before we had the market crash? And you can see we had a high, we stalled out here, and these are monthly candles, and you can see we didn't really move from May until December. And then we saw a sell-off that cleared all the lows in January of 2008. We put a peak in October of 2007. And so we held and couldn't progress anymore. Holding patterns here could be an indication of a top in manufacturing demand. And we went from that peak in 2007 down to these lows, and we saw about a 64-65% correction, roughly what we saw in the broad market. But it was somewhat indicative early that we're in that holding pattern. And we also recovered. Demand kicked in, and we based out in March of 2009, and we started climbing. Now, we can see the growth there in 2009. We can see the growth in 2020 after that. And we can see the move, the pullback in February and March during the initial lockdowns. We started recovering early and quick. So we bottomed out fast, we recovered up, and then we stayed sideways. And the pullback here in 2021 to 2022, that was about a 25% correction. So the industrials gave us that warning there as well, that we're dealing with a correction or pullback in 21, 22. Now the question is this enough? I wouldn't say it's the same kind of holding pattern that we had in 2007, 2008. We stayed pretty flat. And in 2021, 2022, we stayed pretty flat, warning us that we were setting up for a correction of 20-25%, or as in 2007, 2008, 66%. Now this, I would argue, is flat net. But when we look at this, we obviously have a lot of volatility that's going on as we go into the elections. There's your November for the elections, December. We're going up, down, wider candles than we saw in 2007, wider candles than we saw in 2021. But really, here's your close price, and these month-to-month candles still are netting out a very small difference other than that November election update. So as we're sitting here, this could be the warning that we're going into a holding pattern. And if we do go into a holding pattern for 5, 6, 8 months and manufacturing doesn't kick in, that would tell us that demand is not high. And if demand is not high, then what we'd be looking for is the market to react and sell off to represent the lack of demand. And that would be an indication that we should see things pull back, possibly 20-25%. And I'm not going to look for a 66% return or pullback, but I could be looking for a 25% pullback, which would bring you all the way down into this area and bring us back down to 105, 106 and erase all of 24. 2024 could be gone. Now, if we look at this in the shorter time frame, are we seeing indication that that's the case, that we're starting to see that flat go into downtrend? If we're looking at these higher lows, I would say we broke the low today. Now we've recovered, and if we go off of the low shadows, we absolutely broke through the low, and we've recovered and closed back inside that consolidation. And we have somewhat of a lower highs, higher lows situation going on here. But if we did break through that low, that might be our first warning sign that we've got a crack in the industrials area. It doesn't mean I have to go and trade XLI or trust that is the breakout that we're going to move lower. It means that I'm going to start looking at bearish trades in the industrial sector and starting out with some of the stocks like Deere, Caterpillar, Boeing, GE, etc. So let's kind of go through this list. Let's go with GE first. Are we seeing the breakdown? No. Hasn't broke through the lows. It's pausing like I talked about with XLI. It's pausing and holding up near the top. It hasn't really seen the same breakdown that we would be looking for to confirm that we're in a downtrend. Boeing, same kind of deal. It hasn't broke the downtrend. This down there testing it is pretty close, but it hasn't broke free. If it does break free, I would be looking for a move from about 188 to about 168, and there could be a $20 move, which will give you about 13-14% return on a bearish trade on the stock. But if we look at some of these stocks that are having maybe a little rougher time, that have seen bigger drops, Caterpillar broke free from its last low right here. And I was looking for this to break free from this pattern and break free from this price pattern, these higher lows and lower highs, right through here. So we just broke out on Caterpillar. And it did close down, and it's breaking all the shadows, and it's the lowest price Caterpillar has had going all the way back to September of last year. If it repeats this move, 407 to 350, it's really 347, but 407 to 347, we would be looking at a 60-point move lower. And a 60-point move lower would bring you down to 280, if not lower from there. But I would say start with the target of about 320, but it could go to 280. This could be the breakout on the way down for Caterpillar. And if we're not seeing demand and growth in lots of areas, this Caterpillar feeds into the agricultural business and the construction business and government spending. Caterpillar has contracts across the board, and so this could be another sign that we're starting to see lack of demand and weakness. Deere is generally, as we know, focused on agricultural. This is a single candle type of a pattern where we could see that as a bearish move, probably to about 470, but it's not nearly as bearish as what we were seeing in Caterpillar. So I think I like Caterpillar the best as far as the bearish or short types of trade. And it would support that idea, once again, that we're seeing lower demand. Oh, Caterpillar also obviously in mining operations and industrial production, including oil prices. So if we're looking at oil and that we could go over to oil. And crude oil inventories today increased, which means also lighter demand. If oil continues to increase in its supply and demand doesn't pick up, we probably will see oil drop back into the $68 range. And that will still impact industrial because they won't need to have the same kind of infrastructure if there's not the demand to meet the supply. Let's review the three larger aerospace defense contractors really quick in the industrial sector. It's not the same as some of the other things because this will be almost exclusively to government spending. But let's take a look at RTX, Lockheed Martin, and General Dynamic. And we're sitting here coiled up here in the middle. This is an opportunity either way. I'm not sure which way it's going to go, because if we see more conflict and we see more concern, this could as easily go up to the highs as it could to the lows. And I'm looking for about an $8 or $9 move. So I'm looking for about $7 move in RTX. Looking at Lockheed Martin. Lockheed Martin is bouncing here after breaking through these key support levels and putting in a new 52-week low. Any lower high would have me looking for another bearish move. And these moves have been quite dramatic. We're talking about 10% step downs and sometimes 20 and 30% step downs. So any lower high in here could put us back down to see 400 potentially in the next 2 months. And the last one we'll do is General Dynamic. General Dynamic did a similar breakthrough support like Lockheed Martin. And so I'm looking for any lower highs below the 260 area to give us a bearish setup and a move back down to 240. And not as big of a move, but again, about 7 to 10% moves in RTX and General Dynamic. But Lockheed Martin might give you a little bit bigger opportunity to the downside. I would not put that in the same category as our industrials with manufacturing, but it is in the industrial sector, and thought we'd take a few seconds to review those as well. Well, that's going to do it for me today. Thanks for watching. Join us tomorrow, TheoTrade Live, as Brandon and I will take the stage with you. Otherwise, I will talk to you again next week as we continue our Thursday afternoon video. Thanks for watching.